Ladies and gentlemen, welcome to my channel. Imagine having a portfolio so well constructed that it weathers storms, political unrest, inflation spikes, growth collapses, yet remains resilient, still growing. That is not a fantasy, that is possible. What separates successful investors from the rest is not luck, but a set of timeless strategies grounded in principles, cycles, risk awareness, and the courage to adapt. Today, I want to walk you through 9 of the most popular investment portfolio strategies, not because they promise a guaranteed windfall, but because when understood deeply, they can help you build a portfolio that thrives in many different scenarios. Markets don't move in straight lines, they move in cycles, and those cycles are deeply tied to the forces that drive economies, human behavior, and policy decisions. To truly understand investing, one must understand cycles because they shape the environment in which all portfolio strategies either succeed or fail. If you only look at the immediate moment, the headlines of today or the price movements of this week, you risk missing the underlying patterns that determine where things are headed over the longer term. Cycles appear everywhere. There are business cycles where economies expand and contract. There are debt cycles where credit builds up and then must be reduced. There are inflation cycles where prices rise rapidly and then cool down. And there are political cycles where cooperation gives way to conflict and then swings back. Again, each of these influences the return and risk profile of investments. For example, equities tend to do well in periods of strong growth and low inflation, but they can perform poorly when growth slows or inflation rises sharply. Bonds tend to shine in periods of deflation or falling interest rates, but can be punished in times of rapid inflation. Commodities often thrive when inflation is high but lag when growth slows and demand weakens. The challenge is that no one cycle runs independently. They overlap, feed into each other, and interact in ways that make the investing environment complex. When debt builds up too high, it eventually constrains growth, forcing central banks to cut interest rates or inject liquidity. Those actions can create new cycles, sometimes inflating asset bubbles, sometimes igniting inflationary pressures. When inflation runs too high, policymakers try to tighten conditions, which cools growth and can push economies into recession. Recognizing these interconnections allows an investor to prepare for multiple possibilities rather than betting everything on a single outcome. The danger comes from assuming that today's conditions will persist forever. In periods of booming growth and rising stock markets, it's tempting to believe the good times will continue. Yet history shows that expansions are always followed by slowdowns or contractions. Similarly, in the depths of recession or crisis, it feels like the pain will never end, but eventually cycles turn, opportunities emerge, and growth resumes. Those who fail to recognize the cyclical nature of economies and markets often buy high and sell low. Those who appreciate cycles are more likely to anticipate turning points, or at least protect themselves from being blindsided by them. One of the most important aspects of cycles is that they reveal the limits of prediction. It's nearly impossible to say with certainty what the market will do next month or next year, but it is possible to understand where we are in a cycle and what risks and opportunities are associated with that phase. For instance, when debt levels are extreme, growth is fragile, and central banks are already running loose policies, the cycle suggests that risk of instability is high. In such an environment, relying solely on strategies that perform only in expansionary times can be dangerous. By contrast, when credit is low, unemployment is high, and central banks are easing aggressively, history shows the probability of recovery is rising. Recognizing that allows investors to tilt toward assets that benefit from early cycle recoveries. Understanding cycles is not about having a crystal ball. It's about having perspective. It's about stepping back from the noise of daily fluctuations and recognizing that markets are part of larger patterns that have played out over centuries. Wars, technological breakthroughs, demographic shifts, monetary experiments, all of these events alter cycles, but the rhythm of rise and fall, boom and bust, remains. By studying those patterns, one develops a framework for making decisions that is far more resilient than guesswork. The real benefit of internalizing cycles is in risk management. If you know that no environment lasts forever, you will be less inclined to overexpose yourself to a single asset class or a single economic outcome. You will seek balance, spreading exposure across different strategies so that no single turn of the cycle wipes you out. You will be humble enough to recognize that you cannot be right all the time, but you can survive all the time if you prepare correctly. In the end, cycles teach us patience. They remind us that nothing goes up forever and nothing goes down forever. They teach us to avoid the arrogance of believing we can control markets and instead to respect the forces that drive them. For the thoughtful investor, cycles are not a source of fear but a source of clarity. They provide the context within which all investment strategies operate. Without this perspective, strategies are blind. With it, they become powerful tools in navigating the uncertainty of markets. When people first think about investing, the natural focus is usually on how much money can be made. Returns dominate the conversation. What stock doubled, what fund outperformed, what strategy made someone rich. Yet the reality is that returns only matter if you can hold on to them, and you can only hold on to them if you manage risk properly. In fact, the most consistent investors over time are not the ones who chase the highest return, but the ones who are relentless about controlling losses. This may sound counterintuitive in a world obsessed with growth, but it is a fundamental truth. Protecting against downside is more powerful than stretching for upside. Consider the mathematics of loss. If a portfolio loses 50% of its value, it doesn't take a 50% gain to recover. It takes 100%. That is the trap of ignoring risk. A few devastating downturns can wipe out years of compounding. By contrast, if losses are minimized, compounding works more smoothly, even if returns in good years are not the highest. Risk management, therefore, is less about limiting opportunity and more about preserving the ability to stay in the game long enough to benefit from the power of compounding. Risk comes in many forms. There is market risk, where asset prices fluctuate sharply due to shifts in growth or inflation. There is credit risk, where borrowers fail to repay debts. There is liquidity risk, when markets freeze and selling assets becomes costly. There is geopolitical risk, when political instability or conflict disrupts economies. And there is psychological risk, the tendency for investors to panic, overreact, or abandon a strategy at precisely the wrong time. Effective risk management means recognizing these threats and designing portfolios that can withstand them. One of the most effective tools for managing risk is diversification. By spreading exposure across different asset classes, regions, and instruments, an investor ensures that no single shock can devastate the entire portfolio. The key is not just owning a variety of assets, but owning assets that behave differently under stress. For example, stocks and bonds may complement each other in certain environments, while commodities may act as protection during inflationary periods. The point is not to guess which one will perform best, but to balance them in a way that cushions the impact of surprises. Another essential element of risk management is sizing positions appropriately. Even if an idea seems promising, allocating too much capital to it can create disproportionate exposure. No one is right all the time, and assuming otherwise invites disaster. By limiting the size of individual bets, losses are kept manageable when the inevitable mistakes occur. This discipline may feel like it reduces potential profit, but in reality, it ensures survivability and consistency. Risk management also requires humility about what can and cannot be known. Markets are driven by countless variables, many of which cannot be predicted with precision. An investor who builds a strategy assuming perfect foresight will eventually be humbled. Instead, the goal is to create resilience portfolios that can function reasonably well across a wide range of possible scenarios. This mindset shifts the focus from being right about the future to being prepared for the future. There is also the dimension of psychological preparation. In volatile markets, fear and greed pull strongly on decision making. Without a plan, it is easy to sell at the bottom or buy at the peak, decisions that amplify risk rather than manage it. A disciplined risk framework helps keep emotions in check, knowing in advance what level of loss is tolerable, what actions will be taken in different market conditions, and what the portfolio is designed to achieve prevents emotional overreactions. Importantly, risk management is not about avoiding risk altogether. Every investment carries risk, even holding cash, which is exposed to inflation. The goal is not to eliminate risk, but to take risk intelligently, to accept the risks that are rewarded with return, while reducing exposure to those that are unrewarded or excessive. This is why great investors often emphasize that protecting against large losses is more important than chasing large gains. The paradox is that by focusing on risk, returns often improve over time. Portfolios with strong risk controls may not be the top performer in any single year, but over decades they often deliver superior results because they avoid catastrophic drawdowns. They capture gains steadily and let compounding work uninterrupted. Investors who chase returns without regard for risk may shine temporarily, but sooner or later they face setbacks so severe that recovery is nearly impossible. Ultimately, risk management is the foundation of long-term success. It shifts the focus from short-term excitement to long-term sustainability. It recognizes that investing is not a sprint, but a marathon, where the winners are not the fastest at any given moment, but the ones who remain on their feet when others have fallen. By placing risk management above the pursuit of maximum return, an investor builds not just wealth, but resilience. And resilience is what ensures that wealth can endure through the unpredictable storms of markets and time. Diversification is often described as the only free lunch in investing, and for good reason. At its core, diversification is about spreading risk so that no single event, no matter how unexpected, can completely undermine a portfolio. The real power of diversification, however, comes not from simply owning many different assets, but from combining assets that do not move in the same direction at the same time. When assets are non-correlated, meaning their performance patterns are independent or even opposite under certain conditions, the portfolio as a whole becomes more stable and resilient. Think of diversification like building a team. If every team member has the same skill set, They will excel when faced with one type of challenge, but fail when the environment changes. A team with varied skills, however, can adapt to different circumstances. The same principle applies to investing. Stocks may do well during periods of economic expansion, but falter when growth slows or inflation rises. Bonds may provide safety in downturns, but struggle when interest rates surge. Commodities can thrive during inflationary shocks, yet underperform when demand weakens. Real estate can generate income and act as an inflation hedge, but may be vulnerable to credit tightening. By holding all of these together, the weaknesses of one are offset by the strengths of another. The key lies in correlation. Two assets may both offer high returns, but if they are strongly correlated, they will rise and fall together, amplifying volatility rather than reducing it. By contrast, assets that are non-correlated bring true balance. For example, government bonds often rise when equities fall because investors seek safety in uncertain times. Gold sometimes performs well when both stocks and bonds struggle, particularly in inflationary or geopolitical crises. Including such assets in a portfolio ensures that when one part is hurting, another is helping. The result is a smoother overall return stream and fewer catastrophic drawdowns. Diversification also applies across geographies. Different economies move in different cycles depending on their demographics, resources, policies, and political climates. A slowdown in one country may coincide with growth in another. By investing globally, an investor reduces exposure to the unique risks of any single market, whether that be a debt crisis, regulatory change, or political upheaval. A portfolio spread across developed and emerging markets, across regions with different drivers of growth, has more resilience than one tied to a single nation's fortunes. There is a psychological benefit to diversification as well. Volatility and large losses can provoke emotional reactions, leading investors to abandon their strategies at the worst possible times. A diversified portfolio, by cushioning against extreme swings, makes it easier to stay disciplined. Instead of being whipsawed by concentrated bets, the investor can maintain a steady course, confident that no single setback will derail long-term goals. In this way, diversification not only reduces financial risk, but also strengthens emotional resilience. Some investors resist diversification because it can feel like settling for mediocrity. After all, in any given year, a diversified portfolio will rarely be the top performer. There will always be one asset class or strategy that outshines the rest, and owning a mix means you will never fully capture that single best performer. Yet this misses the larger point. The objective is not to win the sprint each year, but to finish the marathon with consistent compounding and without devastating losses. Diversification sacrifices the extremes, both the highest highs and the lowest lows, in exchange for steady, reliable progress. Over decades, this steadiness proves far more valuable than short bursts of outperformance. Importantly, diversification must evolve with the environment. Assets that were once non-correlated can become more correlated as markets globalize or as policies align. For example, in times of extreme stress, investors may sell both stocks and bonds simultaneously to raise cash, temporarily increasing correlation. This means diversification is not a one-time decision, but an ongoing process. Investors must continually reassess whether their portfolio truly holds assets that behave differently or whether hidden linkages have emerged. Another layer of diversification involves time horizons. Some assets are volatile in the short term but highly rewarding in the long run, such as equities. Others, like cash or short-term bonds, provide stability and liquidity but little growth. Balancing short-term stability with long-term growth ensures the investor can weather immediate needs without sacrificing future potential. This form of temporal diversification adds another safeguard against unforeseen circumstances. In practice, achieving true diversification requires discipline and humility. It means resisting the urge to pour capital into whatever has recently performed best, and instead maintaining exposure to assets that may seem out of favor but provide balance. It means acknowledging that no one can predict the future with certainty, and that the best defense is to prepare for multiple outcomes. By blending non-correlated assets, the investor creates a structure that can adapt to growth or recession, inflation or deflation, stability or crisis. Ultimately, diversification is not about eliminating risk, but about making risk more manageable. It accepts that uncertainty is unavoidable and that no strategy works all the time. By constructing a portfolio where different assets offset one another's weaknesses, the investor builds something far greater than the sum of its parts, a portfolio capable of enduring, compounding, and protecting wealth across the unpredictable cycles of history. Investing is not only about numbers, charts, and financial models. It is equally about the principles and mental frameworks that guide decision making. Markets are filled with uncertainty, and no one can predict the future with perfect accuracy. In such an environment, relying on principles becomes a way to navigate the chaos with clarity and consistency. Principles act like a compass. They may not tell you exactly where every twist and turn will be, but they provide a reliable direction. Without them, decision-making becomes reactive, driven by emotions and short-term noise, which often leads to costly mistakes. A principle-based approach begins with understanding your objectives clearly. Every investor should ask, what am I trying to achieve? Am I aiming for long-term growth, stable income, capital preservation, or some balance of these? Once objectives are defined, principles serve as the rules for how to reach them. For example, a principle might be never to take on more risk than can be tolerated emotionally or financially, or to always diversify across uncorrelated assets, or to evaluate investments not just on potential return, but also on potential downside. These rules become anchors that prevent impulsive decisions when markets are volatile or when greed and fear are at their peak. Clarity is essential in this process. Too often, investors are swayed by complex jargon, hot trends, or vague narratives that sound promising but lack substance. Clarity means stripping away noise and focusing on what truly matters, the fundamental drivers of value, the risks involved, and the consistency of a decision with long-term principles. When decisions are made with clarity, they are easier to explain, easier to stick with, and easier to evaluate after the fact. Without clarity, strategies become muddled, and it becomes difficult to distinguish between luck and skill, or between sound reasoning and emotional reactions. One of the greatest challenges in investing is the constant bombardment of information. Every day brings new headlines, expert opinions, and predictions. Without principles to filter and prioritize this information, it is easy to overreact to short-term developments. A principle-based decision-making framework acts as a filter. Instead of asking, what is the market saying today? The better question becomes, how does this information fit into my principles and my strategy? This shift prevents the temptation to chase every trend or abandon plans in response to temporary turbulence. Another strength of principle-based investing is that it allows for consistency over time. Markets go through cycles of euphoria and despair, but principles remain steady. For example, if a principle is to always evaluate risk before return, that rule applies equally in bull markets when optimism is high and in bear markets when pessimism dominates. This consistency provides stability in an environment where everything else feels unstable. Investors without principles often find themselves zigzagging, overexposed during booms and overly cautious during busts, while those guided by principles maintain a more balanced long-term approach. Clarity also plays a critical role in communication, especially for those managing money on behalf of others. Investors who can clearly articulate their principles and the reasoning behind decisions build trust with clients, partners, or even with themselves. Transparency about why a portfolio is structured in a certain way, or why a certain investment is chosen or avoided, reduces uncertainty and fosters confidence. Even when short-term results are unfavorable, clarity in principles reassures stakeholders that decisions were made thoughtfully and consistently. Importantly, principle-based decision-making does not mean rigidity. Principles are not about locking into a fixed strategy forever. They are about having a framework that adapts to changing circumstances without losing its core logic. Clarity helps here as well. When principles are clearly defined, it becomes easier to see when adjustments are necessary. For example, if a principle is to avoid excessive leverage, that remains constant. But the way leverage is measured, or what constitutes excessive, may evolve as new tools or risks emerge. The clarity of the principle ensures adaptability without confusion. Another benefit of having clear principles is the ability to learn from mistakes. Every investor will make errors, but without principles, it is hard to diagnose why they happened. Was the loss due to bad luck, or was it a violation of a principle? When principles are clear, post-mortem analysis becomes productive. Mistakes can be traced back to whether the principles were sound, whether they were applied correctly, or whether they need refinement. This process of reflection and adjustment turns mistakes into valuable lessons rather than discouraging setbacks. Ultimately, principle-based decision-making and clarity bring discipline to a field where emotion often dominates. They prevent overconfidence during booms and despair during busts. They foster patience because decisions are grounded in a long-term framework rather than short-term impulses. They build resilience because even when outcomes are uncertain, the process remains steady and transparent. Principles provide structure, clarity brings focus, and together they create the foundation for investing that is rational, adaptable, and sustainable across the unpredictable landscapes of markets. Adaptability and humility are two qualities that often separate those who endure in investing from those who are eventually undone by it. Markets are complex, dynamic systems influenced by countless variables. Economic policies, technological innovations, global politics, shifting demographics, unexpected crises, and even collective psychology. No one can perfectly predict how all these factors will play out. That is why adaptability is essential. The willingness to adjust when new information arises, and the ability to pivot when old assumptions no longer hold. Alongside adaptability must come humility, the recognition that no matter how much knowledge or experience one has, mistakes are inevitable and certainty is an illusion. Adaptability begins with the mindset that the future is uncertain. Many investors fall into the trap of believing that what has worked in the past will always continue to work. They build portfolios or strategies around a narrow set of expectations, only to find themselves exposed when the environment shifts. History is full of examples, periods when equities delivered decades of strong returns, only to stumble during prolonged bear markets, times when bonds provided steady protection, only to falter during inflationary shocks. The investors who survive and thrive are those who are willing to revise their views, rebalance their portfolios, and reconsider their strategies as conditions evolve. Adaptability means not marrying a single idea, but treating every strategy as conditional, dependent on the broader context. Humility complements this by tempering the natural tendency toward overconfidence. Success in markets can be intoxicating. A string of good decisions or favorable conditions can lead investors to believe they have mastered the game. Yet markets have a way of humbling even the most confident players. When humility is absent, overconfidence grows, leverage expands, and risks accumulate unnoticed until they cause devastating losses. Humility is the acknowledgement that being wrong is not just possible but inevitable, and that survival requires preparation for those moments. It encourages investors to build in margins of safety, to avoid excessive concentration, and to question their own assumptions regularly. One practical expression of humility is diversification. By admitting that no one knows exactly which asset will outperform, diversification accepts human fallibility and builds protection against being wrong. Another expression is setting stop, losses, or predefined risk limits, which acknowledge that judgment may fail and safeguards are needed. Humility also manifests in the willingness to learn from others, to consider opposing viewpoints, and to accept that wisdom is often distributed rather than concentrated. Listening carefully, questioning deeply, and seeking disconfirming evidence are habits that prevent the blind spots of arrogance. Adaptability also requires flexibility in time horizons. An investor may enter a position with a long-term thesis, but if conditions change radically, clinging stubbornly to the original plan can be disastrous. Flexibility means distinguishing between temporary noise and structural change, and having the courage to act accordingly. Sometimes adaptability means holding through volatility, recognizing that short-term setbacks do not invalidate a sound long-term principle. Other times, it means exiting a position entirely when the reasons for owning it no longer exist. The skill lies in balancing patience with responsiveness, and this balance can only be struck by those who remain humble enough to continually reassess their own reasoning. Another important aspect of humility is the willingness to admit mistakes quickly. Investors often hesitate to close a losing position because it feels like conceding defeat, yet holding onto a mistake out of pride only compounds the loss. Humility allows an investor to say, "I was wrong, and it is time to change course," without ego interfering. This simple ability to recognize error and move forward can make the difference between small, manageable setbacks and catastrophic losses. Adaptability and humility also strengthen resilience in the face of uncertainty. Markets are not only unpredictable, they are often uncomfortable. There will be times of fear, panic, and doubt. Without adaptability, an investor may freeze, unable to act in a changing environment. Without humility, an investor may act recklessly, convinced of their own correctness in the face of contrary evidence. Together, these qualities foster steady decision-making, adaptable enough to adjust, humble enough to question, resilient enough to endure. Finally, these traits encourage continuous learning. Adaptability thrives on curiosity. constantly scanning for new information, new trends, new risks, and new opportunities. Humility thrives on reflection, analyzing past decisions, extracting lessons, and acknowledging both luck and skill. The investor who combines these two becomes a lifelong student of markets, always evolving, never assuming mastery, always aware of their limitations yet confident in their ability to navigate change. In the end, investing is not about certainty, but about probabilities and preparation. Adaptability ensures that when probabilities shift, strategies can shift as well. Humility ensures that when confidence tempts one toward excess, discipline holds firm. The market's greatest tests are rarely those of intelligence, but those of character. By embracing adaptability and humility, an investor equips themselves with the qualities that endure beyond any single strategy or market cycle, creating a foundation not only for financial success, but for long-term survival in a world of perpetual uncertainty. In investing, there is no perfect answer. There are only better answers, answers that work reasonably well across many possible futures. The 9 strategies we discussed are tools in your toolbox. What matters is how you use them. Thank you. Let these strategies guide you, but let your principles lead you.